Welcome back to SMSF Mate's daily podcast. This is our general advice warning that we are required to warn you that any advice has been prepared without taking into account your objectives, financial situations or needs, and because of that, you should, before acting on the advice, consider the appropriateness of the advice having regard to your own objectives, financial services and needs, and where the advice relates to the acquisition or possible acquisition of a financial product, you should obtain a product disclosure statement, PDS, relating to the product and consider the PDS before making any decision about whether to acquire the product. Now let's get into it.
Welcome back to SMSF Mate's podcast. SMSF Mate is where Aussie mates come together to get the most from their retirement savings and learn a bit more about super. So today we have a very special guest. Steve, you're from Canstar, and let me see if I get this right. You are the Group Executive, Financial Services and Chief Commentator. Is that right?
That's me, yep.
Welcome, Steve. I'm Tim, and I'm here in the studio with
Gareth
and Ashwin.
Excellent.
G'day, guys.
G'day.
Thanks for joining us.
So, Steve, today we just want to talk a bit about bit about SMSFs and your experience in the space, and just some general information. So, fire away.
Terrific. Well, I guess I do have experience in the space myself because I have one. But that aside, I've seen a lot of people get into SMSF. Some of them are the right people to be doing it. Some of them aren't the right people to be doing it. And what I guess I'd like to talk about is some of the ways you compare the SMF style solution with the more traditional super fund that APRA regulates.
Sounds good. I've got my list of stupid questions ready to go.
Oh, excellent.
So in your opinion, Steve, who is the ideal SMSFer?
Well, to begin with, you must have a pretty sizable superannuation balance. If you're going in there with a couple of $100,000, it's a very, very expensive solution. And you could have good reasons for still doing it, but it's going to cost you a lot. And, I've run up some of the average costs here, and your setup costs, just as individual trustees, say between $700 and $1,000, and add $800 more if you're a corporate, if you want a corporate trustee, and then if you have a borrowing strategy, add another $1,500. So that all adds up to a big number just to set up. Your annual running costs, you can be paying your accountant $700 for a very basic and simple SMSF, but maybe $1,800 for something that has unlisted securities or rental properties or something. You've got audit costs of $300 to $600. You've got ATO and ASIC levies of $500. So if you get the picture from there, you can be up for sort of anywhere from $1,500 to $3,000 and potentially more. So be ready to pay a fair bit if you go into SMSF, and you can't justify that sort of cost on a low balance.
Yeah, so if you've got $100,000, it's only 3%, right? It's $3,000 a year is 3% of your whole return in fees.
That's a healthy chunk going away.
You've got a lot to make up if you're paying $3,000 in fees. So the answer is rarely would that be right. I can't imagine anyone going into an SMSF with, some people say 300 without 300,000 at least. I kind of think maybe the bar could be a little higher at 400,000. You see all sorts of numbers bandied around though, but it will cost you too much, and it would mean you'd have to get extraordinary returns on your investment to warrant being in there to cover the cost.
And Steve, I often sort of liken it to, say, running your own business, in the sense that, it sounds great, that you have all this freedom and, upside potential, the sort of, it's on your back sort of thing. But really, it seems like a lot of work and a lot of effort. And you're right, like, then you, as you said, have to outperform to sort of make up those costs, to sort of make it worthwhile. And you look at, the investments, and often, these like market returns are very hard to beat. And, industry or retail funds tend to sort of just be allocated in those products. And, yeah, there's a lot to consider. You're right.
Yeah, look, there is. And just to sort of unpack that a little bit more, when you look at the returns that have been achieved over the last 5 years by the account-based superannuation, so the APRA funds, they've on average returned over 7% in the last 5 years. The Canstar 5-star rated products have returned over 9%.
Yeah, and that's per annum too, right, Steve? Not on 5 years. Yeah, PA, right?
Yeah, per annum. Now that's a pretty fat return to be getting, and you've got to be, either lucky or a bit of a financial guru to actually come up with returns that are going to consistently outperform those sort of numbers. So I just think your investment strategy should, even in an SMSF, and certainly with those funds I'm talking about, your investment strategy should be also avoiding risk. And to get much more than that 9%, you've got to take on a lot more risk, in particular if you're covering high costs.
Absolutely.
Now, the other thing you mentioned
there,
I think it does. The other thing you mentioned there was a lot of work, and look, there can be a lot of work in this, and it does require a high level of commitment. Now, some people are ready for that level of commitment. Some people have the expertise and the motivation for it. Other people might say, well, look, I really want to do it, but I'm not quite sure how to do it, and I'm not sure that I have the skills for it. So be ready for all of that. If you don't have the skills and or the motivation, you shouldn't be going into it, because you can't just set these things and forget them. You've got when you're paying for your advisor through a superannuation fund, that advisor is monitoring your investments daily. They're putting all the homework you can imagine into it. They're professionals. You have to think, well, as I'm not a professional, what will I bring to the party here that will get me one of those bigger, fatter returns?
I guess it's all in the first two words there, Steve. It's self-managed. So you've got to be directed yourself on what you choose to invest in and what you're trying to outperform with, or, opportunities that maybe you can't invest in super, and that might be the driving force for you to do it. But yeah, you're right. You need the right balance, but you also need to be self-directed and take ownership over what decisions you make. It's not a passive vehicle to be used, I think.
Yeah, there's no one to blame except yourself, right?
Yeah. yeah, that's right. Now, a lot of self-managed superannuation people do have an advisor, and that makes sense. But you still the element of it is you are self-managed. You're either choosing to take the advisor's advice or whatever, but you are effectively self-managed. Now, should you pay for advice? It's expensive, but it can be well worthwhile. But then that's another layer over and above the 1,500 to 2,900 that I mentioned earlier. So be ready for that. But a lot do, and it makes sense for some people.
Yep. So I suppose what would be the benefits or you would see in having a self-managed super fund, Steve?
Yeah, look, there are some things you can do with self-managed super that you cannot do with a traditional fund. And effectively, one of the main things, of course, is a wider choice of investment. Now, you might have a high level of a belief that a certain sector is going to outperform. You might want to put all of your super into Bitcoin or non-fungible tokens. I can't imagine the tax office being too happy with that sort of investment strategy, but that's sort of the
headlines.
Yeah. Exactly. But the reality is that you can go into investments that you can't do otherwise. So if you want to go with your APRA register, your APRA administrated funds, you're really stuck with listed securities and term deposits, for example. Now they can be offshore securities, of course, not just Australian, and they are. But if you want unlisted investments, if you want to buy property, If you do want to buy one of those exotic things that I just mentioned, then you really do need to go self-managed super. You just won't get that latitude through your, one of your big super funds.
So you're telling me I can invest in my wine collection through my self-managed super fund?
Let's get no good in-house assets.
I can see that being a depreciating asset somehow.
Yeah, and the auditor's going to come check that those wines haven't been touched, Gareth. I'm not sure.
Yeah, exactly.
Sure
it's an interesting point because, I mean, even storing them on your premises, I think, would be a very
bit of a red flag, right?
Yeah. I think so.
Self-consumed, self-managed, yeah.
Yeah, exactly. There is another really valid purpose in self-managed super, and a lot of small business people take advantage of this, and rightly so. And that's property purchase, buying your business premises.
Yep.
I think a lot of small business people have gone through the pain of building up a business and getting it to a successful point, and then finding they're priced out of the property, or by a landlord who can find another person prepared to pay a higher rent, and then lose an element of the goodwill that they built up. So the beauty of this is that they can buy their business premises, assure their tenure in the business, but put it through their super. Now it's a non-recourse borrowing. It means setting up a bare trust. It's expensive to do. It's messy. The banks obviously charge more for it because there's a high level of complication and risk assessment in it. But it is a very valid reason for going into SMSF, and a lot of small business people do take advantage of it.
Yeah, and you can't do it in a normal super fund. It
No,
has to be a
you
self-managed.
can't borrow in an ordinary super fund. You need the bare trust as that vehicle to do it. And it's a peace of mind value, I think, for some business owners to do that. But it's still fundamentally got to stack up financially as well. So, it is your super money as well. So, the peace of mind has to be balanced out with those extra costs that Steve ran through. But I think most business owners would get financial advice to fully understand what they're getting into, because it's very hard to undo a recourse loan, and the cost to exit it itself can be a problem.
When you say it's got to stack up, do you mean like the returns on investing in that property versus market returns? Is that
I think you'd be balancing, the rental return you're obviously going to get for your commercial property, but it's also got to factor in the costs of you borrowing money at a certain rate. So you'd hope that the rental return outweighs the interest costs that you're paying. Otherwise, you could be eating into your balance effectively. There'll be reviews typically done by a bank fairly regularly on the fund to make sure it's up to standard.
And valuers every 3 years.
Yep. And then, there might be causes that you have to tip in funds if the value drops to a certain level, because I think where people sometimes get caught out with those borrowings in the super fund is the bank is charging a higher interest rate because the only asset they can get is that property. They can't touch the shares or the cash in your super fund.
Yeah.
Their only recourse on that loan
is a fire sale of the property.
Is the property, because you can't actually borrow against the fund. That's what the bare trust does. So the bare trust owns the property, and that's where the security is held. So it's a strategy around that. So that's where the advisor would, and it's a requirement, I think, typically with all the loans that you get financial advice, so you understand what you're signing, would explain that to you. So
sounds like bare trust might be a topic for another podcast, Ashwin.
It could be. Yeah.
Yeah, the banks get around that risk by taking a personal guarantee from the the trustees of the fund. But it's absolutely right. I mean, if you've got $2 million in your super fund, and you've borrowed, you put 25% of that into a deposit, and you borrowed the rest from the bank for $1 million property, the banks cannot get their hands on the $2 million worth of shares you've got. But it does raise another interesting point that some people sort of are very attracted to the idea of property through their super fund, and it makes sense if in some scenarios, but not all. And if somebody just happened to have a super fund and the only real asset was a property, whether it's your business premises or some sort of other investment property, you've got a real problem on your hands. I mean, you've got fees you've got to pay, you've got repairs, you've got all sorts of other costs of holding the property, and you've also got the risk of having to come up with cash for some other purpose. And it's an illiquid asset, your property. It's all or nothing. You either sell the whole asset, or you're stuck in it. And you just can't overcommit to one investment in your super. And it is a risk that some people take, thinking, look, I love property, and I think property is the way to go.
Yeah, I think that's worth unpacking that a little bit. I mean, it sounds simple, but it selling a property isn't something you can do this afternoon. If you hold $100,000 worth of shares, you can sell 10 grand today, 10 grand tomorrow. You can buy 10 grand back next week.
Yeah, it definitely becomes a problem, especially in that pension point when there's certain drawdowns that clients might not get if they've just got a property in there. But I think it also comes back to the need to have an advisor at certain points in your life, at setup and review points. So you've got a holistic approach to that investment strategy. So you're mindful that, okay, getting close to retirement, if I've got too much in property, it might be time to sell.
Right.
Sell the property so you can then diversify accordingly. So you're not caught into a situation where you're trying to find an 8% drawdown and you don't have it in your fund. So that's where definitely advisors are needed at different points in your life, especially in a super fund.
Yeah, I think it would be very rare for an advisor to say, "Look, put it all into one property."
Yeah, I'll find it very hard to see an advisor say all or nothing on a property. But I think as long as that's presented to a trustee, then they've made a decision, either ignoring it or whatnot from there. I think so.
I think it makes logical sense if you really think about it. Going all in on black at the casino. And then kind of having the black chips stacked there without being able to, take a little chip off the top. If you put it in simple terms like that, it doesn't make great logical sense. You're better off spread your chips around the board a little bit.
Yeah, I hate gambling analogies when it comes to super.
I was about to say, you can't see my face here, but it was a bit, oh no, Gareth.
I prefer the horse racing one. Don't put it all on number 8 in the 6th race. Spread it out to number 8 on the 6th and number 4 on the 3rd, and number etc. It's none of which make very much sense. Yeah, it's the indivisibility as well as the overcommitment to a particular asset, and it's the I'm sorry, I've lost track now, but you can't get out when you want to. Oh, and the other thing is it's being commercial property in a lot of cases. There's a bit more volatility in commercial property than there is in residential, so you could find yourself having to sell because you just have to on a downturn.
Yeah, and by volatility, Steve, means, what property might have been worth $1 million last week or last year is now only worth 800 this year, but you need to sell it this year because you need some money out. You can't kind of wait it out or sell a little bit. You've got to sort of wait, or realise the loss or the gain.
And there's a lot of other property investments that clients can undertake that have that liquidity that, don't fundamentally have to be trying to pick one property.
Yeah, so like a property listed fund or an ETF. What are your thoughts on those, Steve?
Oh well, yeah. I mean, they can form part of the portfolio, definitely. I mean, ETFs are kind of the bedrock these days of a lot of investment strategies, and I'm sure that the big super funds are using ETFs, the big funds managers are using ETFs. It's a way of getting exposure to the general market. At very low cost, and you'd hold aside the 20 or 30% of finessing through other investments, but use the ETF as the bedrock to keep costs down on indices.
That makes sense to me. I guess, Steve, what would be the pitfalls you've heard of with people with super funds, self-managed super funds?
I'm sorry, I think I missed that bit.
So what are the pitfalls you've heard with super funds?
Self-managed.
Look, I think the biggest pitfall I've seen is people going into the borrowing strategy to buy property. It's where they can make the biggest mistake and get themselves into the biggest mess. Going in with too little money just generally means you'll be up for too much cost, with a diversified portfolio. But where you put it all into property with a loan against the property, that can really get you into an awful pickle down the track when you find rents have decreased, you're not quite covering your costs, you don't have enough set aside in other investments to subsidise it and keep you out of trouble. You end up having to sell at the wrong time. That's where you can really get yourself into a mess.
I guess, and we've just on a previous podcast, Steve, spoken about insurances. So I guess if you've got a loan within the SMSF, and then someone within the fund was to pass away, say while still working, unable to contribute to the fund, and then you've got issues around serviceability and that side of it as well. So you're right. It is.
And getting excess cash into super has tax implications. So if you've run out of cash in the fund to pay, what needs to be paid on the loan and the rent and the all that, and then you've got to throw more in, you're paying tax premium on it.
Potentially, yeah. So
potentially,
it all comes back to the reviews and the requirements of the fund. I think the most common one that some people sometimes get caught out with the borrower in the fund is there's usually a restriction that you can't go into pension phase. So if one of the members of the fund is retired and wants to get all the tax benefits of being retired, they won't let that occur simply because if that person goes to the pension phase, they could technically draw their funds out, and that would affect the LVRs and the payback. So some people get caught out on that. I think potentially as an issue.
Yeah. There are many pitfalls in superannuation, and self-managed super is you've made a decision to manage all of those yourself. Now you've got an accountant who's giving you a lot of advice on the technical aspects, your rights and your obligations, but not many of us understand all of those in advance of going into it, and we'll get advice from our accountant on that, and we'll get advice from a financial advisor on the right investment properties. But until you've been in it for a little bit of time, you're perhaps not always ready for some of the things that can go wrong, because you've got to put your sort of personal ruler over the top of these things and say, well, is it likely that will happen to me?
Yeah, and Steve, I think we're all in agreement that there are a lot of considerations that you need to make before taking the plunge into the SMSF space. When you sort of touched on before, when it starts to make sense, when you sort of, I think you mentioned have a balance of sort of 400,000 or above. Can you sort of touch on, that upper end of the spectrum and I guess the benefits, with a large super balance opposed to having that large balance in industry or retail super funds?
Yeah. I think $400,000 is sort of a minimum. Now, I'm not quite sure that even that's a great idea, because you've got to find a way of returning better than that, 9% over 5 years that the super funds have been providing people with. But let's say you do have some millions in superannuation. It can start making a lot of sense, because you start having access to forms of investment and investment deals that might not be available for a regular sort of retirement saver. And at that point, you might say, well, look, to take advantage of some of these deals that are being offered to me as a high net worther, as somebody at least the wealthier end of the spectrum. I need to have a vehicle with flexibility, and self-managed super does that for you. It gives you the flexibility to take on those other investment opportunities that you might be offered. Now, how many of us are getting offered those? Well, not all of us get that sort of offer, and so we don't quite get that freedom. The property purchase in the right hands is the other thing that is quite appealing. But just one last sort of word of warning on that. If you are putting a lot of your super into it, you're kind of doubling down on your business, because if the business fails and you've got a purpose-built property for that business, then your superannuation is going to hurt as well at the same time. So it is doubling down if you do strike tough times. But there are good reasons for going in. There could be cost savings for those very high balances. Mostly around the the investment fees that are being charged by super funds, because they charge on a percentage basis and go up as the balance goes up. But you'll still be up for advice fees if you're taking on an advisor. So there's six of one, half dozen the other in that. But for the right people, SMSF is the right sort of game to be in. For the wrong people, it can be a disaster.
I think just to expand on that as well, the balance is not per individual. You can combine with wife, family. Four beneficiaries? I think you can have
up to six now.
Up to six now. So if you've got 100,000 times six of you, there's 600,000, and in theory, it's one set of fees, one set of compliance. It's
Look, some people, if you've gone down the education framework, it sometimes people use it as a teaching tool for their kids if they're part of the fund, to say these are things we're invested in as a family. But I would say that's the rare percentage of people that are on that mindset. But some people do it for the cost saving. But I would use it more as an education tool. With my personal one is when the kids get to an age, they're only 5 and 3, so they've got a long way to go.
You got a while to go yet.
But that's where I'd like to teach them about money, because I think the biggest issue in my frame, whether it's self-managed or an ordinary super fund, a regulated APRA one, it's too many people sub 40 don't pay attention to their super, and you really need to pay attention in those early years from your first job all the way through to those 40s, because trying to play catch up in your mid-50s after the kids leave home is too late.
We just ran out of time, right?
Yeah.
The compound interest and the market and inflation and all those things that our lovely government keep funding and printing money. You've missed out on.
Yeah.
Sorry, it's absolutely right here. I think that the problem is that people have a cash need, a more immediate cash need when they're younger, and they're buying houses and stuff like that. So they need to do that also, but they shouldn't take the view that, well, I can't afford to put any more in, so I won't worry about this for now. I'll just leave it. The difference between getting into, even with the account-based stuff, the APRA regulated super funds. The difference between our 5-star products and the rest of the market is still 2%. That is not trivial when you put it over 35, 40 years in the workforce. That makes a big difference to your savings. And that's net of fees, but you've got to keep the fees down as well. So people can actually find themselves able to make decisions, even though they can't put more cash in, that will improve their situation at the end of their work life.
Yeah, so Steve, on that, so if you were to give some advice to your 21-year-old self, I can't think of too many 18-year-olds who are earning Macca's money and then paying uni and rent, being able to throw too much in super. But by the time most people get to 21, they can sort of potentially have a bit of a job and maybe swap a bottle of wine every now and then for putting $100 into their super fund. Any advice for your 18-year-old self? Or 21-year-old self.
Look. Putting a regular amount into super over and above the required will make a huge amount. In particular, if you're doing it early, I'd kind of not necessarily say it's right for everybody, because at the end of the day, you do want to buy a house. All of those measures of how much do you need to retire on are predicated on you own a house, you're not having to pay rent.
Yeah, Aussie dream.
So yeah, that's right. So you still have to make sure that you're going to find yourself in a position to buy a house. And at this stage, much as some of us think you might, it'd be good to have some way of accessing it, not permanently to get a house. You can't access it. That's that. You need.
There is that recent thing, Steve, where you can. So the first homeowners savers.
Yeah,
scheme.
but that's true. That's for salary sacrificed amounts. Yes.
Yes. So for those extra amounts, if they put it in there, they could actually end up with a healthy tax return.
Yeah, that's right, and that does make a fair bit of sense. I know it costs a bit of bad press sometimes, but I actually think it makes a lot of sense, that scheme, because it's not diminishing people's retirement situation at all. They're just putting their savings in there and getting a tax advantage while they accumulate enough to buy a house.
Yep.
So that makes sense. But I think that there are schemes that could access your equity in your super to support the risk in your borrowing. I think those sort of schemes might make a fair bit of sense. It's sort of having your cake and eating it. But at this stage, those don't exist. So maybe too much salary sacrifice into super, expecting it to work for you might not work if you can't commit to buying a house at some stage. But that aside, it's all of those other decisions you make that will help you, even without committing more money. It is getting into a lower cost fund. It's getting into a better performing fund. If you're in self-managed super, it means, well, absolutely committing a lot of time to making sure you're doing it right.
Agree.
Absolutely. I think well, you can't see us, Steve, we're nodding our heads. Only downside of a podcast is you can't see anyone. So, Steve, any other words of wisdom from a self-managed super fund? I think personally, it feels very good that we've had a very honest debate about is it for me? Should it be for me? I think I'm hearing an overwhelming message of do your homework. Do you really have enough? Don't just get a self-managed super fund because
it's not something you do straight after a barbecue.
Yeah, right.
Yeah. Look, it sounds incredibly appealing to say take control of your own destiny. Don't pay these big fees to these mega corporations that are our super funds. That sounds appealing, but it's not for everyone. A lot of people will get it wrong and do a lot worse than they would have putting their money into one of the better, higher performing super funds. And make sure that if you are going that option, that you choose one of the better and the higher performing super funds. But there are still some very real and strong reasons for having SMSF. And if you tick the boxes and get a bit of advice on this and say, well, can I put in the time? Do I have the skills? Can I find the advice to do it well? Then they're a good solution.
Absolutely. So maybe, Steve, you could, for those that, kind of work out that maybe self-managed super fund's not for them, no doubt Canstar has a really good way of me sort of comparing some funds.
I'm glad you asked. We do. We compare around 60, it's a bit over 60 super funds. Unfortunately, the field is diminishing with all the mergers taking place. But we compare about 60. There's some mega funds in there. We do a star rating on them. It's based mainly on performance net of fees, but there are a whole bunch of other features taken into account as well. The way you can access and use the thing. So at the end of the day, we highlight based on sort of broad profiles of different styles of people based on the age and the amount people have invested. We highlight a sort of set of funds that might suit people better than the general market. So it helps people to choose a fund. And we don't say to people, this is the fund for you. We'd never say that. That's personal advice. We don't give that. But we say, here are a set of funds that on these criteria have outperformed others in the market. Have a look at them. See which one works for you.
No,
absolutely.
All information is good information for people to make informed decisions. So great idea that Canstar has for that review process.
Thank you for joining us once again. If you're interested in our waffle about self-managed super funds, feel free to join us on smsfmate.com.au or search SMSF Mate in Spotify.